Michael, welcome back. Why do you say that? Why do you have that point of view on the Fed?
Pretty simple, Brian. Highest inflation in 40 years. What does the Fed focus on? Core inflation. It looks at these numbers just like we do and says, those are not even close to good, nowhere near acceptable. Inflation's the ultimate boogeyman for a central banker. You've got to put it back in the box. More tightening for a long time.
Say a long time, you mean like to the January meeting of next year? I see on the graphic it says September of 2023. Is that a typo?
I wouldn't call it a typo necessarily. Right now what the market's been pricing is for the tightening cycle to end somewhere between March and June of next year. And we think the Fed's going to be at it for a bit longer, so probably raises rates well into the middle of next year. And more importantly, goes on a long, extended pause. The market, I think, has a sort of fantasy the Fed's going to shift pretty quickly from tightening to easing. We just don't buy it. So we think that Chair Powell and friends will raise the funds rate maybe through the middle of next year, possibly a bit longer, and say, hey, let's wait. Let's see how this inflation thing dies down a little bit and give it some time. So it's not going to be a quick fix, not a U-turn, nowhere near a pivot.
Because it takes, as we heard on halftime from Professor Jeremy Siegel, it takes a long time for these Fed moves to work their way through the economy. They're not a speedboat. They're a super tanker.
That's right. Long time for those legs. I'd say 6 months, absolute minimum, probably more likely 12 months. So you've got to give the system time to absorb the impact. And frankly, the Fed's first rate hike was back in March, so January would be less than a year. That's just not enough time for it all to play out.
Well, I guess the most basic question, I mean, I try to pretend I'm smart and ask these fancy questions. I'm just going to ask you this. What do we do? What do your clients do?
Yeah, clients are taking cover. So very few clients I've talked to have added risk. You might say, and I certainly appreciate Bob the Celebrity's comments, that sentiment's bad, therefore you want to pile into risk perhaps. But that's not really the way we see it. We look at these times as being just about unprecedented, certainly in the span of our careers and also the policymakers. So when you've got crazy high inflation, all sorts of very strange global factors, the smarter move is to take cover. So keep it short if you're buying bonds. A lot of people have been doing that recently. Don't venture too far out the yield curve. Stay light on credit and think very carefully before hopping into stocks.
So is cash king?
Cash is almost king, but now you can actually get yields on shorter treasuries that look somewhat attractive. So no one's going to get rich buying a 2-year treasury, but the yield did top 450 today for the first time in a long time. Not going to lose a lot of money, so seems like a pretty good safe harbor to us, or even shorter. You still get pretty good yields.
And you get state tax benefits, right? If you buy treasuries directly, we talked about it the other day, you buy a 2-year directly from the federal government, not an ETF. The interest, the coupon payment, I understand, is actually tax-free on a state level. So you do get a little more juice than just the 4%.
That's a fair point. Yeah, certainly comparing that to a corporate, you've got to make that adjustment. So you're right on there.
Michael, it's great to have you on. I can't. It's hard to believe that we're here talking to guys like you, and they're like, get cash. This guy taking a picture of you, by the way. Get cash or buy 2-year bonds, and that's the best place to be. These are remarkable times. Michael Schumacher, thank you very much.